Hello everyone and welcome back to another episode brought to you by Moods Investment Research in Ontario, Canada. Today we're going to be talking about the economy in general and some of the most important issues that are on everyone's mind, which are like high inflation, increasing interest rates, and obviously where to invest in times like these. And if you have invested already, now there is another concern for most of the investors, which is how to mitigate risk for your portfolio. Now, we obviously know one of the main concern for most investors is the falling price for long-term bonds and treasuries, which is what I'm going to be addressing today. Now, if any one of you have invested in real estate, be it your home, and if you borrowed money from the bank, your installment would have doubled over the last 1 year or so, which is what I'm going to be addressing today, as well as to what to do in a scenario like that. Now, obviously, when we talk about the rate of inflation, is the annual inflation rate that we are discussing here. It compounds like a compounding interest. Now, when we look at the cumulative inflation over the last 100 years, since 1913, it has compounded at close to 3,000%. This is one of the reasons why the interest rates have started going up. So how is it affecting the bond prices? So when we look at the long-term interest rates for bond and treasuries today, they are somewhere between 4 to 4.5%, whereas the short-term rates for bonds and treasuries are somewhere between 5.5 to 6%. Now, because the situation is abnormal, because usually what happens in a normal situation where the interest rates for long-term bonds and treasuries are actually higher than the short-term rates, but in a situation like this where the short-term rates for treasury and bonds are higher than the long-term rates for bonds and treasuries, which is why we call this situation as inverted yield curve, which basically points at a recession, which is how it is looked at by most economists. So let's try and understand what is inflation and what is causing this high rate of inflation before we move on to interest rates. Now, inflation is obviously when the prices for goods and services are high, but it's important to know what is driving these prices so high. Now, obviously, when we talk about high prices for goods and services, we are talking about the basic necessities which are required for our day-to-day living, which is like the prices for food, shelter, oil and gas, electricity, transportation, cars, apparels that we wear, and the medical care that we need to lead a normal life. Now, who's causing this high rate of inflation? It's obviously the government when they start spending on infrastructure to create jobs and keep the economy running. So when the government overspends, which is when the inflation runs rampant, which is when the Fed actually steps forward to increase the interest rates. Now, the Fed, which is the Federal Reserve, which is obviously a private entity that serves as the central bank for the government of US, which is when it comes to its rescue when things get out of hands. The Fed also acts like a lender of last resort for most of the banks in the US. So let's look at the impact of high inflation and increasing interest rates on long-term bonds and treasuries. So Vanguard, which is considered to be one of the best exchange-traded funds holding long-term bonds and treasuries, is already down by about 30 to 40%, what we can see here. So the question is, where does the government get all this money from? So the government gets its money from taxes, which is the revenue for the government. It borrows by issuing these long-term government bonds and treasuries, which are called T-bills. And thirdly, it's quantitative easing, which is when it prints money to pay off that debt when it becomes due. Now, here's the biggest question. Can the government really print unlimited money whenever it wants or as it pleases? So the answer is yes, especially if you're US with a GDP that's well over $20 trillion and an economy that's churning and producing. So the US is able to print money as much as it likes. That is because the US has gone off gold standard in the 1970s when Richard Nixon was the president of the US, and being a Republican, a libertarian, he introduced his neoliberal economic policies. This is one of the reasons why the US has so much of debt today, because it has the ability to print and pay off its debt. Therefore, as part of their neoliberal economic policies, Nixon and Reagan, when he came to power, reduced taxes instead of increasing them, and just kept borrowing to fund the economy, which is why the US has so much of debt today, which is in excess of $32 trillion, which is 125% of its GDP. So for us to understand where we are today, it's extremely important that we look at the historical data for inflation. So when we look at the historical data for inflation, it seems like we've been in similar situations many times before. So when we look at this chart here, it seems like the inflation during World War I was pretty high, close to 25%. So immediately after World War I, we can see here that the inflation rate dropped down to a negative of 15%. So when we look at this chart here, it indicates that there was a deflationary period between 1920s up until 1940s, just before World War II. So again, during World War II, we have seen the inflation had reached at about 20%. So one might very well argue that it's actually high rate of inflation which led to these wars. So we're going to see if that is the case in a while. So let's move on to the next chart here. So it was not just the high rate of inflation or high interest rates which were reduced. So even the marginal tax rates were reduced from some 94% to 30 to 40% that we see today by the Reagan administration starting in the 1970s as part of their neoliberal economic policy. So why are we discussing all this, and why is it so important that the government is so concerned about high inflation? Now, high inflation obviously creates a lot of uncertainty. It's not good for pensioners who are on fixed income because it erodes the value of their buying power. And most importantly, it's not good for the banks because it reduces the value of their loans, which is basically their assets. It also causes unemployment, which is obviously not good for the economy. That is because it creates misery. People, when they get unemployed, they are unable to afford their basic necessities which are required for their day-to-day living. Therefore, when we look at the misery index here in the US, when inflation is high, interest rates are increased, which is what creates unemployment in the economy, breeding more misery and more inequality in the society. And this is when the situation becomes more dire for the citizens. Now, who benefits from this high rate of inflation, high interest rates? Obviously the government and large corporations, but not the ordinary citizens. This is because the government debt that we saw is in excess of $30 trillion and the debt for large corporations get eroded, which is good for them. However, for you as an ordinary citizen or as an investor, is obviously bad, which is why you need to protect yourself and your wealth. Now remember one thing, the Fed being a private entity actually benefits from increasing interest rates. And I'll tell you why. This is because when the interest rates are reduced, that is when the Fed actually tries to rescue the government and buys the government bonds. This is exactly what we saw happening in 2008 when the interest rates were reduced to almost zero or even negative in some cases. So the ultimate beneficiary for all this is the government, is the Fed, and obviously the large corporations. So when the US government wants to inject more money in the economy to revive the economy, it issues more bonds and treasuries, which are then sold to the Fed and also to the other countries like Japan and China that actually then own the debt of the US. So when the interest rates are low, you also benefit as an ordinary citizen. That is because then you are able to keep your job. You are also able to do well, which is when the economy is flourishing, and you're able to borrow from the bank because the risk is low. The bank you can borrow as much as you want to buy a home or even invest, let's say, in stocks or in a business. So in a situation like that, there's too much of money and liquidity in the economy, which is why the economy flourishes. This is when the inflation rate goes back up again, which is when the Fed, from being a net buyer, increases the interest rates and become a net seller, selling back all those bonds and treasuries back to the government at a higher interest rate. So now you know where the problem is and who benefits from it. So even for you as an ordinary citizen or as an individual investor, it becomes difficult. That is because when the interest rates are increased, you are unable to borrow more. So if you want to buy a house, you are unable to borrow more. And if you want to have cash to invest, you are unable to do so. Now, because the risk for the banks have gone up. And even if you own a home and you borrowed money to buy that house, the installment on that loan would double. And even if you're working and you get a pay raise, it's not going to help you much because it will not increase your buying power in nominal terms. That is because if the inflation rate is at 10% and you get a raise of about 10%, so it's not going to make any difference because the net effect is just going to be zero. we have seen how increasing interest rate benefits the government and the Fed. In fact, the Fed more than the government that benefits from increasing interest rates. That is because the Fed is able to buy government bonds and treasuries at a lower rate, and then when it increases interest rates, it's able to sell it at a higher rate, whereas you don't benefit anything as an ordinary citizen. This is the reason you have to protect yourself and your investments, because the Fed and the government don't care much, except caring for the large corporations. So we have seen in the previous chart how increasing interest rates have actually affected the bond markets with long-term bond prices falling. So let's look at this closely as to what it does to bonds and equities and what should be your strategy. So when you look at this table here, and when you look at the situation today with high rate of inflation and with interest rates increasing, that is when you have to be in stocks. And I say that because generally, as a rule of thumb, when the interest rates go up, that is when the bond prices actually fall, which is what we are seeing today. So basically, there's an inverse relationship between interest rates and the bond prices. So what about equities? So generally, equities are less affected by high rate of inflation and high interest rates. Historically, they have performed better than the bonds. That is because it's easier for a business in an inflationary environment to reprice its products and then pass on all those additional costs onto the consumers. And it becomes even more easier if you are a monopoly or an oligopoly like Apple. So when you look at the historical returns, equities have actually performed better over the last 100 years, returning 11% on average annually as compared to 5 to 5.5% for the bonds. And that is one of the main reasons why you should remain heavily invested in equities. And I say that because when you look at the performance of equities, they have performed way better than the bonds. That is because when you look at Tesla and Meta, they are up by more than 100% year to date. There's no harm in reducing exposure a little bit though. Perhaps what you can do is 60-10, which is 60% in equities and 10% in short-term bonds. And the remaining 30% in cash. You've got to hold on to your cash. This is the way you can hedge the risk for your portfolio. You may invest in equities that pay a higher dividend, somewhere between 8 to 10%, which is easier to find. Altria being one of them, that has been growing its dividend for the last 50 years. So you might be able to find quite a few in that category. This is not to say that you should be investing in Altria. Obviously, you have to do your own due diligence, but you should be able to find a lot of opportunities similar to this. Another place to look at is special situations like liquidations, if you know how to do it. So you can split that 60% into high dividend, high growth 40%, and the remaining 20% in special situations like liquidations. Special situations like mergers and acquisitions and liquidations have actually done quite well for us over the years. So slowly and gradually you can keep accumulating equities. You could also do short-term treasuries or non-callable bonds, allocating 10% of your total capital without exposing too much. So this is how you pair and hedge risk in your portfolio. You have to keep investing in equities till the interest rates reach at about 7 to 8%. The interest rates will keep increasing. That is because the Fed in their last meeting have indicated that they'll keep increasing interest rates till they have reached a target of 2% for inflation. So when the interest rates reach at about 7 to 8%, hopefully in the next 3 to 6 months, that is when you would be able to find opportunities in bonds and treasuries selling half their par value, which is when you can start increasing your exposure to bonds and treasuries. So to summarize, you have to have a high exposure to equities as compared to bonds. You should be holding on to cash because there's going to be a lot of opportunities showing up in near term. Now the equities have to be in high growth, high dividend paying stocks and special situations. Now even in special situations, you should be looking at businesses with less debt, which means less than 50% of its equity. Now in times like these, there would be a lot of special situation deals. That is because there would be a lot of smaller companies which would be taken over by bigger conglomerates. And if you buy at the right price, you would be able to find, even if there's a liquidation. There could be a lot of companies sitting on a lot of cash, which will have a lot of current assets such as inventory, which is easier to sell. You might be able to get a higher value than what you paid for when they get liquidated. And if you're already distressed, that is because you already invested and your portfolio is down. There's nothing to worry about if you're investing in equities, because ultimately they will recover, what we have seen when we looked at their performance for the last 100 years, provided you have invested in quality stocks and they have quality earnings. But even if you have not, you can always cut down your losses and you can switch. And last but not the least, and I always say that, you always have to look within. So you don't have to look outside. You can always reinvest surplus cash in the equities that you already own in your own portfolio, which are compounders and growing. Now, if you are already distressed because of increasing interest rates, because you have invested in real assets like property, even if it's your home, there have been instances where people have been able to renegotiate their terms with the banks. So if you are already on variable and your interest rate has gone up, you have to make sure that the interest rate on your loan is repriced at a lower rate, fixed for another few years at least. So finally, the relationship between the high rate of inflation, high interest rates, and the wars. Now, obviously, I can tell you from my experience, and because I have studied political economy, there's a correlation between high rate of inflation and high interest rates. That is because it creates misery, unemployment, and inequality, which is why the situation of a war is created, ultimately leads to a war. So that's it from me for today. Hopefully you have gained some valuable insights. Thanks for listening to me, and I'll see you in the next episode with a different topic.